I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on CyclesMan.com. Welcome back to the show, Tim.
And Jim, thanks as always for having me.
Wow, what a jumpy market. Is it schizophrenic or what?
Yeah, it's. I don't think people realize what's going on, and I don't know if we talked about it last time or not. Sometimes I don't remember what we discussed in the last interviews, but as the industrials pressed to the new high back in October, and leading into that high, even the week before, we saw the couple of weeks before, we saw some pretty shabby internals. The industrials pressed to the new high with 41% of the NYSE stocks above their 200-day moving average. Only 41% as the industrials were making the new high. On October the 3rd, we saw that, which was the day of the high, by the way, we saw 3.5 times as many new 52-week lows as there were 52-week highs. So again, it was a kind of some poor internals associated with that high. And as I have said all along, the industrials have provided cover for, the higher degree setup that is slowly trying to take place. This last month we saw some, technical deterioration in some more of the indexes, averages, and sectors. And now here we sit with a little bit of a bounce.
Tim, what does this mean for the average investor?
Well, what I think is happening, is I say what I think is happening, what I'm pretty sure is happening, is that, let me give you an example. I had a phone call from someone, and this is not meant to be financial advice. It's an observation. But I had a phone call from someone, a relative, and he was saying, look, I've had my retirement with, so-and-so company, and, I'd been doing really well. And he said, over the last year, he said, all of a sudden, he said, the market had been up, but he said, I'm not making any money. I was making, whatever he said, 15, 18, 20%, just constant. He said, all of a sudden, he said, this last year, he said, it's just not doing good. What do you think? And so I told him about actually those very numbers that I just gave to you, how as this market has moved to a new high, it's been a bit of a mirage. Just what I said, the industrials have provided cover, whereas, like those numbers are telling us, that the internals and many of the stocks, 41% of the NYSE stocks were below their 200-day moving average. So it's telling us that there's an internal deterioration has been going on. But again, the industrials have been providing cover. And so what does that mean for the average investor? I think that I had said when the 09 low occurred, and I had no way of even imagining that this thing would last and be blown up into the bubble that it has been. But I made the comment, I said, the longer this lasts, the more dangerous it will become. And what I meant by that is the complacency that it would be spawned from it. And I think that's where we're at. I think that's the main danger, and what it means to the average investor is we have this higher degree setup that's been slowly taking place with commodities and the bottoming of the dollar, which we've talked about, and the topping of, when I say the topping of commodities, I mean the topping of commodities and gold and most all asset classes. We've seen enough technical damage this last month that, many of the U.S. sectors even, but some of the foreign markets that have been structurally leading, we've seen enough technical damage where you can say that a higher degree top has been seen there. And so what I'm saying is that this higher degree setup, the evidence continues to suggest that it is continuing to form, that it is falling in place. But as a whole, the sheep are asleep, if you will, because the appearance with the mainstream indexes and averages, the S&P and the Dow, is that everything's okay. But people are starting to notice a little bit, evidently, based on that phone call, that, hey, why am I not doing so good? So what I think it means to the average investor is that they're going to be blindsided by this. I think that is a tragedy, because they don't know what's going on. They don't understand what's going on. They're not going to tell them what's going on CNBC. And then once it, if it does finally, or not if, when it does finally begin to, the house of cards begins to cascade, then they're going to be trapped. And so that's the tragedy that I see and what it means to the average investor.
Well, didn't we hear that executives started selling off their stocks some time ago?
Absolutely. And as the insider trading, that's a reported thing. And, I used to have a website. You could look at that and see who's selling what, but yes. And then, whenever we saw the weakness that we saw, people would send me little blurbs and emails and stuff from different, news services or whatever, and you turn on the TV and you'd hear the comments and they're trying to tell everybody that everything's okay, everything's fine, it's a buying opportunity, the economy's good, first one thing and another. And so, people that like I said, that's part of the tragedy. I mean, you're not going to get I've got a book from back in 29. The warnings were everywhere. The technical people warned about the top. William Peter Hamilton called the top, according to the Dow theory back then. And then you had I've got a little book with all the quotes from the politicians and economists and the like that told everybody everything's fine. Look back at 2000. Did anyone? No one's going to come on CNBC or CNN or any of the other channels and tell you, hey, you know what? They're not going to do it. It's not going to happen. And so that again is part of the tragedy. And it is what it is. Nothing changes.
Tim, what's the best advice you can give to the so-called average investor?
Well, I don't want to give advice to, the financial advice to the average investor, but I'll just say in generic terms, I like I told my cousin, I think that the best avenue is to just be on the side and be safe, not to be in this market, because, it's just, I feel like there's just too much risk at this level, knowing that it is an extended bubble, looking at the fact that, the internals, like you said, and then like he was looking at hard facts, he was looking at his portfolio not doing well. And I just think the sidelines, I think the dollar is going to be king. That's going to be the safest place to be.
Looking at currencies, is the U.S. dollar going to retain its strength? Because we have so many conspiracy theorists, I might call them, who feel the U.S. dollar at any moment is going to collapse and the only thing that people will accept is gold. Do you see any sign of that?
I understand people saying that. I get it. I understand, the argument against fiat currency. I get it. I understand the argument for gold. I get it. Totally. But, the fact remains is that, the U.S. dollar is the reserve currency of the world. And you asked me, one thing I do remember in one of our recent interviews, maybe in the last interview, you said something about, some of these countries are talking about, moving to another currency and trading and buying oil in something other than dollars. And, that doesn't work out too well. The U.S. is going to defend the dollar. And we looked at, the all year. I remember the first interview we did back in January, something to the effect you asked about what was one of the, and I'm paraphrasing here, one of the surprises for the year going to be, and I said the strength of the dollar, the bottoming of the bottom, because there was a 4-year cycle low due in the dollar. And by the way, I know the dollar is off today, but that's a short-term thing. And yes, there's going to be declines and counter-trend moves and that sort of thing, but the dollar cleared a major hurdle yesterday, from the longer-term perspective. So the dollar looks really good, longer term.
We'll have more with Tim Cyclesman Wood right after this.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, are there any stocks that might be immune or semi-immune to any decline, things like utilities or foodstuffs, things that you need every day, and no matter what happens in the world, like toilet paper, you're going to need it?
Yeah, and I'm sure there are, but that's not a specialty that or something that I've looked at, so I can't answer that question directly. Just in as the market as a whole, when the market goes down, most things go, sure. There's always going to be some shining stars during those environments, but what they are, that's not research I've done. Maybe I need to look into that and try to figure out a few things that would hold up and throw that out there for people. But at this point, no, that's not something I've done. In effect, if we could back up a little bit, I want to talk about oil and commodities here because I mentioned it in the beginning, and I said that I think that there is this much higher degree setup where all asset classes are peaking, including commodities, oil, the whole thing. We have the 3-year cycle top in the CRB is pretty solidly in place. The evidence is it's been there that the May high was the 3-year cycle top and that we should go lower. We did see the additional push up in crude oil, which was not expected. I mean, I knew it was a retest of the previous high, but I didn't expect it to go to the new high that it did. But that's okay. It still, I think, was a final push up into what should be the 3-year cycle top in crude oil, and since it has weakened, I think we're off about 2% today as we speak. So. Again, the overall setup is falling into place, and to put this all in perspective for people, talking about the average investor, is if you just think about something, it's just common sense if you just think. The Fed has been fighting, and I say the Fed, the money masters, bankers around the world, they have been fighting deflation since 2000. That's what this has all been about. That's not a secret, it's not a conspiracy, it's a fact. I mean, that's what the monetary policy has been fighting, deflation. And they have done a masterful job kicking the can down the road, as they say, over and over and over and over, and creating this enormous equity bubble. Last time, in 2007 and into 8, it was in commodities and stocks. This time it's primarily in stocks. Commodities have, obviously not made the new highs that they made back then, and looking at some of the structure, it's not as strong, so they're leading, but the overall setup is continuing to fall in place. So what I'm saying is that those deflationary forces are still at play. They haven't gone anywhere. And yet we have this equity market that's been blown up into this ginormous bubble, and now these technical or cyclical, however you want to say it, this setup, higher degree picture, is slowly falling into place. And when it does, I think that these deflationary forces will ultimately take hold. You know, it's like the old commercial. I don't know if you remember it as a kid, but remember the butter commercial or whatever it was, margarine commercial, and it raised the little lid and said, it's not nice to fool with Mother Nature. It's not nice to fool with Mother Nature. It's going to, I guess, lack of a better word, revert to the mean. And in doing so, it's going to, the bubble is going to be corrected. It's going to implode. It has to. And the question is this the point? Is this technical juncture that we're at now, which is an opportunity for that to happen? Is this it? I don't know. But it's certainly an opportunity.
Tim, is this going, so instead of seeing quite often when you have a major crash, the market just falls off the shelf and splatters on the floor, is this going to be a gradual step down, and is that what's confusing a lot of people? It's down for 3 days and makes a marvelous recovery, but it's just not quite as high as it was before.
You know, that's what's happened obviously so far as this setup. Like I said, the setup is still trying to take hold in some indexes, averages in sectors that you're not looking at, like, you know, automotive. If you look at the automotive sector, if you look at housing, you know, it's been down. But if you look at, again, like the industrials, it's been more like a yo-yo. It's been a lot more subtle. And so, yes, that's where we are today. Like I said, these underlying indexes, sectors, averages, you know, we've seen the breakdown. We've seen enough structural deterioration where you can say, okay, the top should be in place short of some other kind of market miracle. When I say market miracle, I mean some sort of an intervention type thing where, you know, it gets resurrected again. But structurally, yes, it's in place in some of this stuff. But again, in the mainstream U.S. markets, it's being hidden. We're not quite there yet. The structure, when I say we're not quite there yet, the structure's not in place. We're in a position where it could fall in place very quickly, but it's not quite there yet. And, I guess the question is as we set up, yes, that's the environment we're in. But once the setup is firmly in place, I'm not so sure. I'm not so sure that it doesn't, you know, something doesn't happen, that the unraveling doesn't happen much quicker. And again, part of that tragedy, like I was talking with my cousin about, I said, you know, here's the thing. You wake up one morning, the market's down 1,000 points. You know your portfolio's been doing bad, and you say, well, you know, it always bounces back, so I'm going to wait. And you wait, and you wait, and you wait, and the bounce never comes. Or the other thing is the bounce comes, and you go, well, you know, everything's fine. You know, it always bounces back. It kind of removes the fear, and you stay in, and then you find yourself back in the first situation when it does finally crack. And so that makes for a very difficult environment for the average guy. But like I told him, I said, look, what's the risk if your personal, and again, I'm not giving financial advice. I was talking to my cousin. I said, if your personal portfolio is not doing well, knowing these risks, why be in? You know, just be on the side and let it pass. You know, worst case scenario is that it passes and nothing happens, and then, somehow this thing mends itself, and there is a buying opportunity. Things do turn around. The technicals do begin to look better, and then you can get back in. But sitting here with the current risk and the things that have occurred at this point, I think is I don't know, maybe detrimental.
Maybe not a good idea to listen to the yell and sell guys on TV.
Or the long-term hold. You know, I get that, but, you know, I go back an example of that. I go back to, 1929, someone was in 28, 29, I want to say it was 24 or 5 years. My memory is a little rusty on that, but 24, 25 years before the market got even again. And so that's a mighty long time to wait. In some cases, I don't think you can necessarily, I think that's also possibly part of the trap. I mean, you can't look at this market and say, well, it declined whatever the numbers were, nearly 40%, 36, whatever it was percent in 2000, and it bounced back in the 2007 top. And so it bounced back, let's call it 6-7 years, whatever, or 5 years, I should say, from the 2002 low. you can't count on that being the case this next time. I mean, maybe it is, but I suspect this time is going to be much different than that.
Tim, is it really a case, especially if you're near retirement, it's not a bad idea to be conservative?
Of course not, and that's exactly the context in which I was speaking to him about, because he was talking about he's going to retire and starting to plan for that in the very near future, and I'm like, dude, why in the world would you want that risk? And take your marbles and put them in your sack. Don't be exposed to that.
Coming up, we'll have a question about gold for Tim Cyclesman Wood right after this.
Vadic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vadic's management has extensive potash exploration and development experience in Thailand. Vadic will have marketing advantage compared to Western producers. Drill program commences this spring. Vadic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vadicventures.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, a question from one of our listeners. They ask, as I understand it, gold has been very left translated after it peaked in the current cycle in 2016. Could this cycle be a very shortened gold cycle, not the usual 8 or 9 year cycle, with possibly a final low in the gold market concurrent with the first big leg down in equities, as was the case back in 2008? Technically, can a new cycle up in gold begin as soon as next year?
The short answer is, no, I don't think so. And the reason is based on the norms. In 2008, we had a different setup. In 2008 and into 9, as equities flushed out into the 2009 low, March of 2009, we had a 9-year cycle, 8 to 9 year cycle, whatever you want to call it, low that was due in equities. In gold. So it happened to be that coincidentally those, the flushing in equities and the bottoming of the 9-year cycle coincided at the same time. Here we have a different situation. We had a 9-year cycle low in December of 2015. And to see a 9-year cycle low, one thing I've learned in this business is you never say never, because, that's something this environment is should have taught everybody. But based on the norms and every statistical measure, there is no way that you could reasonably expect to see another 9-year cycle low 3 years later. The other problem with that is that we are so far past the norm for an extended 9-year cycle. So I'm not going to say that we couldn't see some sort of a significant bounce along the way with gold. If the market did start to let loose and, some real fear was seen. But until I saw hard structure to say that, it wasn't something other than a counter trend bounce, every indication is it would have to be a counter trend bounce at this point. I just don't see, an argument, based on the structure, based on the statistical norms, based on normal duration of the cycles, that we could have a meaningful low anytime in the near future in gold. And by the way, I know that kind of goes back to the thing about gold being money, which I understand completely the argument. But the fact remains is that if you look back in 2008, everything went down together. And if you look at the structure here, commodities and gold have been setting up with these higher degree cycles. So that thinking is on track. It's confirming itself. We're seeing it. 3-year cycle top commodities. I know that oil has held on a little longer than expected, but We're seeing evidence that top is in place. We look at the raw materials data, which is something else I've been covering in the research letters. I mean, everything tells us that this data is correct. So it doesn't make sense that you would see this overall weakening in commodities, but somehow gold not included in that, because they historically track together. So I just don't see it. I'm sorry. I don't.
Tim, thank you so much for being on the show.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You can find us on Twitter at House Street, our YouTube channel, Talk Digital Network. Questions for our guests like Tim can be sent to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.